The S&P 500 is down 8 to 12% from its 2025 highs. Your portfolio statement probably doesn't look great right now. But here's the thing: that red ink might be telling you something important. I'm going to walk you through what historical data actually shows about moments like this, and spoiler alert, it's probably not what the panicked headlines want you to believe. This is Money Moves Daily, and today we're building your market correction playbook. Not financial advice, but a framework for thinking clearly when everyone else is losing their heads. Let me start with a number that might surprise you: 37%. That's the average return investors have historically earned over 24 months after buying during pullbacks like this one. And that's not cherry-picked data. According to analysis from the market capitalist, buying the S&P 500 after an 8 to 12% correction has delivered those returns in 95% of cases since 1950. 95%. That's not a guarantee. Past performance never is, but it's a historical pattern worth understanding before you make any moves. So what separates investors who capitalize on corrections from those who panic sell at the worst possible moment? That's exactly what we're covering today. First, let's establish where we are right now. The S&P 500 has pulled back 8 to 12% from its 2025 highs. Some growth sectors are down even further, 25 to 35%. This pullback is happening against a backdrop of real concerns: elevated valuations, geopolitical uncertainty from the Iran conflict, and sticky inflation keeping the Federal Reserve cautious about rate cuts. On March 18th, the Dow fell 768 points. That's 1.63% in a single day following the Fed's latest decision. Headlines screamed crisis. But here's where understanding definitions matters. A correction is a decline of 10% or more from recent highs. A bear market is 20% or more. Right now, we're firmly in correction territory. And that distinction matters enormously for your strategy. According to research compiled by 24/7 Wall Street, corrections historically recover faster and more reliably than bear markets. So the million-dollar question becomes, are we in a garden variety correction, or is this the beginning of something worse? Let's look at what the data suggests. The Motley Fool reported that prediction markets now indicate a stock market correction is more likely than not in 2026. That elevated risk is already priced into current sentiment. The S&P 500 Shiller CAPE ratio, that's a valuation metric that smooths out earnings over 10 years, is currently near its second highest level since 2000, when the dot-com bubble burst. High valuations don't necessarily mean imminent crashes. Markets can stay expensive for years, but they do suggest more modest forward returns are likely. Goldman Sachs agrees. Goldman Sachs projects global stocks to return 11% over the next 12 months. That's respectable, roughly in line with long-term averages, but it's not the explosive gains we saw in 2023 and 24. Now here's what has analysts genuinely split. According to Seeking Alpha, the probability of an S&P 500 bear market is roughly 50% in 2026. That's a coin flip. But before you let that 50-50 statistic panic you, let's look at what distinguishes corrections that become bear markets from those that bounce back. Analysis from the market capitalist identifies key indicators. The current labor market remains intact at 4.1% unemployment. Credit spreads are manageable. Bank balance sheets are strong. Those three indicators, employment, credit, and banking health, have historically been reliable warning signals before true bear markets. Right now, all three are flashing green. This is why the market capitalist's analysis concludes that current conditions suggest a correction rather than the beginning of a prolonged bear market. The economic foundation is intact. Compare this to 2008, when unemployment was rising, banks were failing, and credit markets had frozen solid, or 2002, when corporate earnings were collapsing after the dot-com excess. Today's pullback has different DNA. The Iran conflict and inflation concerns are real, but they're not the structural rot that causes prolonged bear markets. Now let's talk about what happens when you buy during corrections. The data here is remarkably consistent. According to the market capitalist, Buying after 8 to 12% declines has delivered positive 24-month returns 95% of the time since 1950. And not just any returns, an average gain of 37% over those 2 years. That's not a typo. 37% average returns by staying disciplined when others were selling. This brings us to the psychological challenge. Understanding data intellectually is easy. Actually holding your positions or buying more when every headline screams danger? That's where most investors fail. Your brain is wired to see falling prices as danger. It's the same instinct that kept your ancestors alive when a predator appeared. Sell now, survive, think later. But markets aren't predators. A 10% decline in the S&P isn't actually dangerous to your long-term wealth unless you make it dangerous by selling at the bottom. Here's a quote that should be framed in every investor's office. According to the market capitalist, for disciplined, long-term buyers with a 5-year horizon, this may represent the most compelling risk-reward setup since the March 2020 COVID lows. March 2020, remember that? The market dropped 34% in about a month. Fear was everywhere. And then, it became one of the greatest buying opportunities in modern history. Investors who bought during that panic saw the S&P 500 roughly double over the following 3 years. Not because they were lucky, because they followed the historical playbook. So what's the playbook for right now? Let me give you 5 principles that historically separate successful correction investors from those who wish they'd acted differently. First, resist the urge to panic sell. This sounds obvious, but it's the single most common mistake. Historical data overwhelmingly favors staying invested through corrections if your time horizon is 5+ years. Second, consider dollar cost averaging if you have cash to deploy. 24/7 Wall Street calls this the empirically superior alternative to timing the market, investing fixed amounts on a regular schedule regardless of short-term direction. You don't need to time the exact bottom, nobody can. What matters is systematic buying when prices are lower than they were, rather than waiting for some perfect moment that may never clearly arrive. Third, use this moment to stress test your portfolio. A correction is a live drill. If you're losing sleep over your current allocation, that's valuable information about your actual risk tolerance versus your theoretical one. Fourth, focus on quality. Companies with strong balance sheets, consistent cash flows, and reasonable valuations historically recover faster from corrections than speculative names. The names that dropped 50 or 60% in previous corrections often didn't come back or took a decade to recover. Quality tends to snap back. Fifth, and this is crucial for anyone within 5 years of needing their money, ensure that portion is in more stable assets. Corrections can take 12 to 18 months to recover. If you need funds for a house down payment next year or tuition in 2 years, that money shouldn't be riding out a correction at all. Time horizon determines strategy. Now, a word about what not to do. This is where I see otherwise intelligent people make devastating mistakes. They try to get clever with timing. They say they'll wait for the market to fall another 5% or wait for some signal that the bottom is in. Then, they miss the sharp rebounds that historically happen without warning. Some of the best days in market history have come immediately after the worst days. Miss those rebounds waiting for clarity, and you've severely damaged your long-term returns. So here's your action framework. Review your current allocation. Ask yourself, can I genuinely hold this through another 10% down if it happens? If the answer is no, adjust now, not in a panic later. If you have cash to deploy and a 5+ year horizon, consider establishing a systematic buying schedule, monthly contributions into a diversified index, regardless of what the market does tomorrow. And document your reasoning now while you're thinking clearly. Write down why you're staying invested or why you're buying. When fear peaks, that written record becomes your anchor. I keep an investment journal specifically for this purpose. During the COVID crash, I wrote my reasoning for buying. Months later, when the recovery came, that entry was the most valuable thing I'd ever written. Let me leave you with perspective. U.S. Bank's analysis reminds us that corrections are normal market behavior. The S&P 500 has experienced a correction roughly once every 18 months on average since World War II. This isn't unusual. This isn't a signal to panic. This is the price of admission for participating in long-term equity returns. Volatility is the fee you pay for above-average long-term performance. If you want zero volatility, you can have a treasury bills and savings accounts offer exactly that. But historically, you'd sacrifice significant wealth-building potential for that comfort. If you found this episode helpful, subscribing means you won't miss our next deep analysis when something moves in the markets. We're here every week breaking down what matters for your money. The analysts will keep debating whether this correction becomes something worse. Prediction markets give it roughly a coin flip. But here's what we know with more certainty. Investors who bought during similar pullbacks historically came out ahead 95% of the time over the following 2 years. That's not a promise markets can always surprise us, but it's a powerful historical pattern. Whether this pullback is your best buying opportunity since 2020 depends entirely on your personal situation, your time horizon, your risk tolerance, your need for the capital. But if your timeline stretches 5 years or more, the historical data offers a clear message. Corrections are typically opportunities, not disasters. The discipline to act on that knowledge separates successful long-term investors from the rest. Remember, this is educational content, not financial advice. Every situation is different, and a qualified advisor can help you think through your specific circumstances. I'm just here to make sure you have the data. I'll see you in the next episode. Until then, stay disciplined, stay informed, and keep making those money moves.